Delphos Insights. This is episode 40, where we examine capital raising in the Western Balkans and the financing structures that help transactions reach financial close. If you are looking at the region right now, you might see billions in available capital and maybe think the hard part is over.
Right. Yeah, you'd think so.
Yeah, but you would be wrong. I mean, having the money isn't really the hurdle. The real constraint is, well, it's structuring readiness. It is a lot like structural engineering in a seismic zone, I guess.
Oh, that is a really good way to put it, actually.
Right, because you can't just stack capital like bricks and hope it stands.
Yeah.
You must select the exact foundation, like a specific de-risking instrument to absorb local fault lines and risks before you ever even approach a lender.
Exactly. That is exactly the right way to think about it. Capital only flows when those local risks are clearly identified and priced.
Right.
And mitigated. So the deal is actually ready for investment committee review.
Yeah.
The availability of funds is just the weather, Your structuring readiness is the foundation.
Okay, so let's unpack that weather first. What is actually driving so much investor interest toward this corridor right now? We know the infrastructure demand is there, but what are the specific forces shaping this capital window?
Well, we are tracking three primary drivers here. First, nearshoring is materially reshaping supply chains. Like 11% of surveyed foreign firms report relocating production closer to the EU.
Wow, 11%.
Yeah, it is significant. And that generates very structured demand for logistics and energy assets. Second, there is a severe infrastructure deficit. It is currently sitting at 50% below the EU average.
Right, 50% is a massive gap.
It really is. And third, regional trade growth is just compounding the need for modernized facilities.
Okay, wait, so we have this massive infrastructure deficit and an influx of nearshoring. And if you add to that the timeline for EU enlargement, like Albania targeting 2027, does that accession timeline naturally guarantee financial closes for these projects?
Well, actually, no, it doesn't.
Really? I would think that's the ultimate green light for investors.
You would think so, but the accession timeline is just a strong catalyst. It doesn't replace the requirement for rigorous financial structuring on a pro-project basis.
Right, because you still have those specific risks.
Exactly. What it does do is lower the sovereign risk premium. Just signaling that local regulations are aligning with EU standards shrinks that premium.
Okay.
It creates a defined re-rating window for institutional capital.
So it improves market access over time. But again, you still have to build the right shock absorbers for the specific risks on the ground. Back to that seismic zone analogy.
Right. The foundation still needs to be engineered.
So what exact tools are developers using to absorb these fault lines? Because the risks out there are significant. I mean, we are talking political risk, currency volatility, execution, war, inflation.
Yeah, you have to pair the specific exposure with a precise mitigation tool. So let's look at political and commercial risk on the debt side. That is where DSC and OP guarantees come in.
Right. Those act as public backstops to absorb those early shocks.
Exactly. Or take MIGA, for example, the World Bank's political risk insurance. If a host government suddenly expropriates an asset or you can't get your currency out of the country, MIGA steps in.
To make the equity investors and lenders whole.
Exactly. So MIGA is essentially a geopolitical shock absorber.
And what about when macroeconomic pressures rise? Like if regional inflation is hitting, say, 6.4%.
Well, then EU grants become critical to reduce that first loss exposure. The toolkit is really deep. It includes concessional loans, senior secured debt, blended facilities, and private placement notes.
Right, and if we trace the historical transaction record, we can actually see how this toolkit evolved as the market matured. We started with these heavy public guarantees and moved toward private structures.
Right, let's look at how this played out historically.
Yeah, so back in 2005, there was a Kosovo hydropower transaction for $5.5 million US, and that utilized a straight loan guarantee.
Right. In the very next year, in 2006, you had a Bulgaria power project for $1.3 billion US.
1.3 billion? That is a massive scale up.
Yeah, but because the market was still so nascent, they absolutely had to lean on public backstops. No other mechanism could adequately price the risk, so they required MIGA political risk insurance.
Right. And as the foundation stabilized, the tools got more sophisticated. By 2017, a Ukraine financial services deal for $10 million US utilized an OPIC commitment.
Exactly.
And then in 2019, a Romania energy pipeline expansion for 179 million euros leveraged an EU grant. That grant essentially signaled the project's priority and offset the early exposure, right?
Precisely. Those public backstops and grants lead the market. They take on the early friction. And that sets up the recent repricing of the market we are seeing now.
Right, because the foundation is stable enough for private institutional capital to just build on top.
Exactly. Look at 2023. A Greece shipyard transaction for $125 million was successfully structured using senior secured debt.
So the progression is really clear. In the early days, public guarantees were the heavy shock absorbers. Now we are seeing private institutional capital stepping in.
And that is the practical implication for sponsors. Institutional private placement notes only enter the capital stack once public cover has repriced the market.
And establish a track record of completed deals.
Right. Private institutional capital follows only once the risks are mitigated. Capital only flows when risks are identified, mitigated, and structured for review.
It is all about sequencing. Which brings us to the most critical takeaway for you as a listener. Looking at your own pipeline, how are you sequencing your de-risking instruments to ensure bankability and investment committee readiness before engaging private capital?
This has been Delphos Insights. Learn more at delphos.co.